If you're not investing in 2025, you're falling behind. Every single year, inflation is eating away at your money, and just saving isn't cutting it anymore. But the good news is that you don't need thousands of dollars or a finance degree to start investing today. In this video, I'm going to take you step by step how to start investing. And the best thing is you don't need to have any experience. Let's get into it. First, let's talk about why investing is so important. Nowadays, your average savings account gets you less than 1% per year, while investing in the S&P 500 has generated about 7 to 10% returns over its whole lifetime. Now let's take a look at the saving versus investing calculator here at Ally Financial. So we're going to assume that our starting principal is $5,000. We're going to invest $150 monthly, and that the S&P 500 will return about 8% per year, and that our savings rate will be 1% per year, and that our time frame is 30 years. Let's see what the results are. So if you were to, like I said, invest or save $150 a month for 30 years, starting with $5,000, you would have a total of $70,000 at the end of 30 years. However, if you have invested, you would have had $280,000. This is more than $200,000 in difference. That is game-changing money. That is enough to put a down payment on a house, a big down payment. So this is precisely why you need to start investing. When you just save your money, you're missing out on these returns, which is the difference between losing your money to inflation versus actually building wealth. So first things first, now that we know that building our wealth is super important, we have to choose a brokerage account. Now, there's four main ones that I would say are super beginner friendly, and that'd be Vanguard, Webull, Fidelity, and Robinhood. Now, personally, I wouldn't recommend Robinhood for serious investing because they have a lot of misusage of information and other reasons why people don't like them. So then I would eliminate that one and decide from these three. Now there's pros and cons to all of them. I personally use Vanguard for my Roth IRA and the taxable. I also have Webull. I have a friend who uses Fidelity and he's very happy with it. My one con to using Vanguard is I can't buy fractional shares of like ETFs that are not there. So if I just plan to invest in VOO, that's fine. Webull, my one con is that you can only set up one bank account with it for tax purposes. And like I said, I haven't used Fidelity, but I've heard a lot of good things about it. So here I'd recommend choosing one of these three, and to know exactly which one, do your own research and see what would fit best for you. Now that you've decided on your brokerage account, it's time to get to the fun part. What should you actually invest in? So there's two ways you can go about this. One is stocks. These are your individual companies. Nvidia, Tesla, Apple, Google, AMD, any of those companies. Those are all individual stocks. So you can buy one share of this company and be a partial owner of the company. However, since you're only investing in one company, you're exposed to a lot more risk. So let's say you invest in Apple, but then suddenly this brand new company comes to disrupt the phone industry and they take a lot of Apple's market share. The Apple stock will plummet down, and so will your investment. So what I would recommend is to invest in ETFs. What are ETFs? ETFs are basically baskets of stocks. So when you invest in an ETF, you're not investing in one company, you're investing in a bunch of them. And by doing this, you minimize your risk and allow yourself to still partake in that uptrend. Now, like I said, this is less risk, but also less reward. You're not going to have those gains where, if, for example, Nvidia recently went up 200% in a year, you're not going to have that with ETF. However, you're also not going to have the risk of going down 200%. Now, here's what I would recommend to do for your ETFs. It's a simple three-fund portfolio. First, I would do 50% in a S&P 500 ETF. This could be VOO or any other S&P 500 ETF that you like. Next, I would recommend a NASDAQ equivalent ETF. So this ETF will be a little riskier, but it will be composed more of those tech giants or informatics giants, those big companies that are more volatile but can generate you more rewards over the long term. For this, I would personally recommend QQQM or QQQ. I personally use VGT because I use Vanguard, and yeah. And then finally, I'd recommend a dividend generating ETF. For this one, I personally use SCHD. There's a bunch of other ones. Some people use DGRO. Like I said again, this is all up to you, but these are the three funds I'd recommend: 50% VOO, 25% QQQM, and 25% SCHD. Now that we have our brokerage and what we're going to invest in, we need our investment strategy. Now here's the most simple and effective investment strategy. You're going to choose, let's say $50, and you're going to invest it every week or every month or every 2 weeks. Here, the point is consistency. Wealth is built through consistently investing in the market. Whether it goes up or whether it goes down, you're going to consistently invest, let's say every month over that time frame. Now, the next most important thing is to never panic and not worry about the market is doing from day to day. You're planning on holding these things for 5, 10, 15, 20 years. So it doesn't matter what happens today, tomorrow, or next week. What matters is the overall trend over the next 20 years, which is going to be going upwards. Because the S&P 500 has never generated a negative return in any 20-year period. So as long as you hold these investments that you're going to dollar cost average into, which basically means buy $50 every single month, you will make money and build wealth over time. The next step is automating your investments. Most brokerages nowadays allow you to auto invest. This means you can easily have your dollar cost average amount taken from your bank and put into your brokerage account, and even invest it into your ETFs without even lifting a finger. Imagine this, you don't even have to do anything. Just set up your auto invest, let your auto invest go for 20 years, and you'll generate wealth without even having to think about it. Finally, now that you're all set up and ready to invest, here are some mistakes to avoid. First things first, don't try to time the market. You're never going to know when the market's at the bottom or it's at the all-time high, so the best thing to do is to just keep consistently investing. Next, never go all in on one stock. This is eliminating all your diversification and opening you up to a lot more risk. Like mentioned earlier, if this one stock plummets, so will your investments, and that's a horrible way to see all your hard work go to waste. Finally, don't panic sell during a crash or correction. It's normal for the market to go 5, 10, even 15% down some years. It's part of the process. You shouldn't panic and sell all your investments. Instead, enjoy the low prices that you're getting to buy more of those quality ETFs that you want to own forever. And by avoiding all these mistakes, you've already improved your investing game 90% more than what it was before. And that's how you guys can start investing in 2025. If you found this helpful, drop a like, subscribe, and look forward to new videos every single Monday. Also, leave a comment. What's the first ETF or stock you're going to buy in your new investment portfolio? Thank you guys. Take care. Have a great day.